Good afternoon, everyone. Thank you for joining us. My name is Paula McCain. I'm a recovery business advisor for the uh, North Central Texas Small Business Development Center. Today is National Chocolate Souffle Day, as well as National Sleeping in Public Day. Looks like one probably causes the other. I'm not sure, but the SBDC is a leading provider of assistance for small businesses. We are grant funded, and because of that, we can offer our services and resources to you at no cost. Today's presentation, Audit Proof Your Business, is being presented by Angela Randolph. If you would, please go ahead and put all your questions or comments in the chat room, and Angela will get to them throughout the presentation. Thank you for joining us, Angela.
Thank you, Paula. I appreciate that. Let me get my slide deck up here. Can you see that?
Yes, we can.
Okay, good. Audit Proof Your Business. Special thanks to the North Central Texas SBDC for giving me this opportunity to present this subject matter to you today. I'm very excited about it. I'm a CPA licensed here in Texas, CEO of Stella Ledgers, where we provide outsourced CFO, controller, and other financial accounting services, consulting and training as well. 20 plus years of corporate accounting, finance, state and federal tax audits, and Big Four public accounting, and most recently, federal tax audits at the IRS. Okay, so here's the disclaimer. This presentation is for information and educational purposes and does not constitute tax or legal advice, nor is it intended to convey a thorough treatment of the tax code sections. Please consult with a tax professional for any specific circumstances and any tax law changes. So today, our learning topics, our learning objectives are going to be small. We're going to talk about small business and taxes all throughout. We're going to go over some audit stats, types, and selection, how audits are selected, the top IRS audit red flags and triggers, how to minimize your taxes and audit risk, what to do if you get a notice of an IRS audit, best practices for tax preparation and audits, your rights as a taxpayer doing an audit, after an audit, your rights, period, where to get assistance for IRS disputes, and then we'll wrap it up with the Q&A. All right, so small business and taxes. Small businesses are very sensitive to tax law, especially changes in ways that big businesses are not. And what I mean by that is large businesses, which is the group that I came from, they have the resources to hire, and sometimes before the IRS can even roll out training to auditors, they have tax accountants, tax lawyers, they have Big Four consulting firms on deck to kind of help them navigate through tax law changes and prepare them to take advantage and benefit from those changes where small businesses may not have those same resources. 75% of small businesses are pass-through entities, meaning they pay tax at the individual on their 1040 at individual tax rates. Few small businesses have in-house accountants to handle taxes. So most times the administrative task falls to owners, diverting them from their core businesses. Lacking tax expertise, 89% of owners rely on outside tax preparers. Fiscal year 2020, the IRS collected $3.5 trillion. And the most tax came from these three states, California, New York, and right here in Texas. States with the largest refunds where they were issued is California, Texas, and Florida. Some interesting facts there. So let's talk about the audit stats. Generally, over the last decade, the workforce in the IRS have been declining. And I guess I didn't add to that because I left it. But people are retiring, but they've been having budgeting issues, so they can't really do active recruiting. Now, with this Biden administration, I believe when he came in, he pledged to fund the IRS to not only staff up, but also begin to target high income uh, net worth individuals. And they've already started that process. In fact, before I left, I was on a project that was charged with at least having 7% coverage nationwide on high net worth individuals. And these are individuals with 10 million or more in assets. And they own several businesses. It could be partnerships, S Corps. And so the approach with the IRS was taken, they're going to audit it all, not just the 1040, but also the 1120S, the partnerships, everything under their under their sphere of influence um, of the high network individual um, is going to be subject to audit. So that I'm sure they're going to continue that on into the next fiscal year, but it's all subject to funding with government agencies. So just to give you like some background on the audits, this is the latest information that was published by the IRS. In fiscal year 2020, they closed a little over 500,000 tax audits that resulted in 12.9 billion in additional tax compared to the previous fiscal year, where they closed 771,000 tax returns that resulted in 17.3 billion in tax. So what this means is they have collections. We already talked about 3.5 trillion that they collect. And so on top of that, as a result of the audits, and we'll talk about the kind of audits that they've been doing here lately, this is additional tax that's collected on top of that, okay? So for all returns filed tax years 2016 through 2020, the IRS has examined only 0.63% of individual returns filed and 1% of corporation returns filed at the end of fiscal year 2020. Those numbers seem really, really low, those percentages. The IRS processed more than 240 million federal tax returns and supplemental documents in fiscal year 2020, just to give you a perspective on the amount of data that they're processing every year. Okay. So let's talk about the types of audits. You have correspondence audits, which is audits that are done by mail. You may not see an IRS agent. They may not even be in your local jurisdiction. They should, when you get the letter, it should have some contact person's name on it. You want to make sure that it's not someone impersonating the IRS. And then you also have in-person, or what they're now doing is virtual audits, where you either were pre-COVID, you were meeting either at the IRS office or at the taxpayer's place of business. And since the last 2 years, what they've been doing now is virtual audits, like either over Zoom, government, or some other. WebEx is another tool that they use where you can see the examiner and they can see you. And the IRS conducted the majority of the audits via correspondence, 72.6%. And that was pretty much the same as last fiscal year, 2019, and the remaining field audits, 27.4%. And so the IRS has recognized that through, budgetary constraints and people retiring and the overall labor force shrinking at the IRS, that they have to come up with additional ways to check for compliance, right? And so two of the more recent popular programs is the automated substitute for return and the automated underreporting program. So these programs don't require a lot of manpower. They don't require, staff, all the things that you would need to go through if you have a field team of examiners on the case. So as you can see, for fiscal year 2020, automated substitute for return brought in an extra $5.6 billion here in this yellow section here. And what that is these are for people who just haven't filed at all. They just haven't filed a return 1 year, several years. the IRS will detect that if you've ever filed a return maybe once and you haven't the last 2 or 3 years, they'll go in and file one on your behalf. And usually that does not include any tax credits or deductions, okay? But they can, from different sources, surmise what your income would have been. So it's an estimate. And usually people don't find out that this is even happening until they get a tax bill. So you definitely want to make sure that you are filing your returns on time and you file for an extension during by the deadline, and then you adhere to the extended due date so you don't get caught up in this automated substitute for return. Now, the automated underreporting compliance program, this is where you filed your return, but you've left some things out, mainly income. And the IRS gets reports from different third parties like banks, um, other businesses where you may have done some contract work with. They are obligated, and starting this year, it's going to be payment processing companies like PayPal, Stripe, Square, Veeam. Um, and the threshold has been dropped from $20,200 to just $600. So the IRS is going to be getting more information from more sources about the income that you're generating. So it's going to be very important that you keep up with that income, your 1099s. Um, if you don't get a copy, you want to make sure you get a copy so that, excuse me, that you can properly report this on your return. Because as soon as they file, the IRS they already have this information on you. And so this program is going to compare what you filed to what they have from third parties in terms of how much income was recorded. And it's very easy to forget, especially if it's something that was done in the middle of the year, beginning of the year, and maybe you've moved and you don't get the 1099. But the IRS has it. And everything is by EIN or social security number. So even if you moved and you don't have it, this is where the compliance for underreporting your income is going to come in, this orange section right here. And so for fiscal year 2020, they've collected $3.9 billion just by running this compliance program. No field audits, no agents, just by running this software program. And then you see in this blue section, math error notices. If you're preparing your own returns or if a professional is preparing them and there's an error, there's a software program that can catch those as well. And that generated, let's see, is this on here? No, we just have the breakout correspondence, automated reporter, and field examination. Okay. So I don't know the materiality of these math error notices, but there's a system, a software that can catch those, and depending on how huge that error is, that can result in additional taxes for you. So you want to make sure that your math is adding up on your tax return. So even though the field examination only made up a very small percentage in comparison to these other compliance activities, it still brought in $10.1 billion in additional tax for fiscal year 2020. So, I don't think they're ever going to stop doing it. And whatever year they begin to beef up, examiners, usually there's a 12-month training period, then you will probably see this number get bigger and the number of audits increase. So we just don't know when that's going to happen. But usually they'll balance this out with other compliance activities to make sure that they're getting coverage in these audit areas. Okay. So let's talk about how audits are selected. There's what we call a random selection. And what that is your return is going to be compared against others in the industry. And if there's something like these triggers that we're going to be talking about later in the presentation, and if there's something that is triggering your tax return among the collective group in your industry, you could possibly be selected. And even once it gets to the examiner, they have the option, once they look at your individual return, because it could be assigned to them, and they still have the option to pass on auditing if they look at it and they eyeball it and they don't see anything that's standing out that's material, or they have an option to pass if they just have too many other audits going on. So they have that option. So you won't know whether or not they've passed on it or not, but obviously if you are selected for an audit, you're going to get notified via mail. And then there's this computer generated score that's assigned to every tax return that's filed. Um, and with that score, it can generate either an average, high, or low number compared to others in your industry. So there are audits that are generated either if your score is too low, you could be audited, or if the score is too high, you can also be audited. So that's another way that audits are generated. And then there's a whistleblower program where, let's say, for instance, and I see this more in larger businesses where you may have laid off an employee or an employee left in the huff, and they'll call into the whistleblower hotline or send in information to the IRS to report that company where they used to work for non-compliance. Now, you can imagine the IRS doesn't have the manpower to, really investigate every claim, and they have to decipher, is this something that is relevant, or is the person who got dismissed upset that they got fired? So they have to really weigh the issue and see if it's something worth pursuing. And if it is, it'll get passed down to the audit group, or if, on a smaller scale, if you're bragging about, not filing taxes or doing something that's illegal, people can, because there is a reward involved. I forget what it is, but it usually takes a couple of years to kind of, because they don't pay it out until the audit is completed. So just know that this program exists, and if your employees don't need to be involved in the tax filing or tax preparation, then it should only be those professionals that you hire to handle that information, sensitive information. Just keep that in mind. And then you can also be audited as a result of a related examination. Let's say, for instance, you you have investments in other businesses and they're under audit, and the examiner is doing an audit and they want to expand the audit to you. It could be issue related, it could be something else that's causing them to expand the audit and then now pull you into the audit. They can do related entity examinations, and they would also constitute related examinations that they add on years. So let's just say, for instance, that they're doing 2019 and they haven't see an issue that's going to be resulting in additional tax. They may add on 2020 if they see that this issue is also being impacted in the subsequent year. That's also considered a related examination. And so they have a right to do that, add on years to expand examinations. Now, it's up to you to decide if they're coming up against statute limitations. You don't have to extend the statute. You don't have to give the IRS additional time to do an audit. That's perfectly up to the business owner, the taxpayer. Now, you want to consider, if you are having an audit, that the additional time is for you as well to file an appeal if you don't agree. So just keep that in mind if an examiner is asking you for, a statute waiver, that you're able to weigh whether or not you want to, if it's going to benefit you as well, if you want to extend the time for the audit completion. Okay. So let's talk about the timeline of audits. The IRS has 3 years to assess tax from when a return was filed. Higher income tax returns are more complex and they usually take more time to complete, several years after the tax return is filed. So that's not out of the ordinary. Typical audits for high income taxpayer involve at least 3 different tax years, often include related entities, and routinely take years to resolve. Now, on a small business scale, they're not going to take years to complete. Usually they would wrap that up normally within a couple of months, depending on the availability of records, the examiner's inventory, how many audits they have going on, the response time from the taxpayer. But some of the larger businesses, they can easily take a couple of years to complete. Now let's talk about some of the red flags that could trigger an audit. Income. Kind of talked about this already. Unreported income. So the IRS receives W-2, 1099 reports from different companies and organizations that have paid you. And that also includes casinos. You know, there's lots of casinos in Louisiana, and you go there, you have a great time, you hit the jackpot, and you go to collect your money. By the time you get in your car, they have already reported your winnings to the IRS. Okay. And so, like I mentioned before, it's so easy to forget, you know, that this money, you came into this money if it's not a normal part of your activities, you know, like a job or something, or a consulting gig that you may have. So if you fail to report these winnings, you know, on your tax return, then that's going to trigger, that's, you're definitely going to get a letter. No question about it. Now, whether or not it'll turn into a full scale audit, that depends. But you definitely will get one of those correspondent mail letters in the mail. Okay. So this is a very, very common issue. Even with people who work a regular W-2 job, they may forget interest that they have collecting, you know, on maybe certificates of deposits or wherever. You know, just know that these organizations are required to report the 1099. And they also should be giving you a copy of the form as well. But again, if you don't get it in time, or if you move or something happens, then this is usually how unreported income can trigger a correspondence audit. And then on the other hand, we have income that you do report. If you're using round numbers, you know, that can create a red flag. The examiner could question whether or not this is accurate, right? Also, if there's huge swings in income from year to year, usually downward, right? Because the more income you report, that would be subject to taxable income as well, right? So when they're doing the examination, just know that they're going to ask for every bank account that you have, open or closed, during that tax period that they're auditing, and they're going to do a gross receipts test on during the examination. So you want to keep track of all your records. Even if you've closed the bank account, you want to keep that last statement that has zero balance on there. Otherwise, that could be an issue for you if you can't produce the records. Okay. All right. So on the expense side, also reporting round large numbers for expenses, that's a huge red flag. So try to be as accurate as possible when reporting your expenses. If everything is just like perfectly rounded, that is what they will call an unusual item, right? And it could be that it's right, but the goal is you don't want to trigger an audit if you don't have to, right? And the defense of anything that's accurate is substantiation. So try not to use round large numbers for expenses if you're trying to estimate. Be as accurate as possible. Another common thing for expenses, and we'll talk about the automobiles more in the next section, 100% write-off of vehicle expenses for business use. Most people don't fall in this category. And it happens a lot. And people think also that by putting a vehicle in the business name somehow means that you can write off everything related to that vehicle. That is not true. If the vehicle is not part of your business, if it's not an ordinary and necessary expense for your business, then the IRS is going to question that almost always. And then another thing, higher than average deductions. Again, the IRS has this huge database of everybody filing tax returns in your industry, right? Because on the tax return, you have indicated what industry you're in, your NAICS code. And so they can compare, if your deductions are higher than average. In and of itself, if they're actual expenses, that's fine. But just know that if you get a letter of being, audited by the IRS, that could be the reason why. And again, if you can prove and substantiate that you, for whatever reason, spent more than the industry for a particular area, then, and it was necessary for your business, then you'll be fine. And then another one, consecutive business losses. Now, in the beginning, when you start your business, it's expected that you're going to have a net operating loss, what they call NOLs. But in the IRS is going to take the position probably around year 5, especially if the losses are increasing year after year. They're going to question whether or not you're actually in business to make a profit, or is this a hobby, right? Because they can't really tax you on losses. And so they're going to look really closely at your background, how you're running the business. They're going to conduct a thorough interview with you during the audit. And if they determine that this is not a viable business that you're in for profit, they could disallow all of your business deductions and tax credits and just conclude that this is a hobby. Okay. So you want to be very mindful of that as you go into year 4 and 5, that, those consecutive business losses, what's driving those? Is there something happening in the industry, or, being too aggressive with the business deduction? So you're going to get asked about that for sure. Okay. And then another one that's often abused is the home office deduction. There is a caveat, and we'll talk about that more. You have to regularly and exclusively use your home office for business. It's not that you have an office location somewhere where you're leasing space and you work from home one day a week. You're not eligible to get a home office deduction in that scenario. So that's one that happens a lot. And then also excessive meals, entertainment expenses are no longer eligible for deduction at all. So that was repealed with the Tax Cuts and Jobs Act in 2018. So that's one that's often looked at quite often. And then also unusually large charitable contributions. And what I mean by that is, the IRS is going to look at the amount of cash, amount of income that you're reporting. And so if your charitable contributions far exceeds that, they're going to do one of two things. They're going to wonder, where's the rest of this money? What's the source of this money? Where did it come from? And if it's not on the tax return, why isn't it on the tax return? Are they going to presume that these charitable contributions are not legitimate? So these are some of the more common expense areas that will trigger red flags with the IRS. Okay. So let's talk more about the vehicle expense deduction. So you have 2 methods that you can use: the standard mileage rate or actual expenses. Either one is perfectly acceptable. The problem here is that people usually don't have the substantiation for actual expenses, and they're just guessing at it. And the other thing is, like I mentioned before, they're trying to deduct everything related to their vehicle, even though they use it also for personal use as well for business use. And when you use it for both personal and business, you have to allocate a percentage of that business use. So that's the part that you get to deduct your expenses for, not anything for personal, taking the kids to school, going to the grocery store, nothing like that. So you have to keep very good records, and we'll give you the sample mileage and expense log here that will help you track and log each trip that you take for business purposes, the start and stop of the odometer readings, the purpose of the trip, where you are, dates, any additional expenses related to that trip. And so when you do this each time you have a trip, by the time the year is over and it's time for you to report your taxes, then you'll have something to kind of back up the numbers that's on your tax return. Okay, so this will be something that you can start using each time. Now, unless you have a vehicle that is specifically is a work vehicle, it's a company vehicle, then yes, in that case, you would be expected to expense everything related to that. But most small business owners, unless you're in the delivery business, a courier business, medical, or some kind of transportation business where it's essential for you to have a vehicle, most people already are aware of that ability to do 100%. Where the triggers come in is that it's not essential for people to have a vehicle in their business, and they're doing 100% business deductions. So that's a huge red flag, and it's often abused a lot. All right, so let's talk about meals and entertainment. There used to be, prior to 2018, where you could include meals and entertainment together when you're having meetings with prospective clients, with your employees. So entertainment was completely cut out. So that is no longer, if you're doing your bookkeeping and your tracking, you definitely want to separate those two. You can still track it for book purposes. It just can't make its way to the tax return, entertainment. Okay, so you want to separate business meals and entertainment on your books so it doesn't accidentally get on your tax return. So, but they're still kept intact. Business meals are still generally 50% deductible. Either the employee or the business owner must be present during this meal. The cost of the meal is not lavish or extravagant. The meal is with a potential customer, employee, vendor, or consultant. So they don't have to be a current client or customer. It could be someone that is a potential, And then the meal has to have an ordinary and necessary business purpose. So what I mean by that is if you're working at home and you're ordering Uber Eats or DoorDash, that wouldn't qualify, right? I mean, you're present, but nobody else is present, okay? So, however, let me give you another example. If you have like an office space or a meeting with clients or your employees, and you're ordering food in for everybody, and you're going to have like a meeting to discuss, the plan for 2022, then that's different. So just getting lunch for yourself during a normal work day, that wouldn't constitute a business meal. Okay. And so the substantiation that you'll have to track, the amount of the expense, date, time, and place of the event. And like I mentioned before, meal costs must be separate from entertainment starting with 2018. The business purpose, the name of the associates that were present, the relationship of the people. Is it a customer, client, potential customer, employee, and anything over $75 you want to keep the receipt for. Okay. So let's talk about the home office deduction. This is one that is very popular in terms of being audited. Either people just really don't understand it if they're doing their own taxes, or they may not know what the criteria is, or they may include expenses that really don't qualify at all. I've kind of heard combinations of all those things in terms of the home office deduction. So for one, it has to be your principal place of business. And that doesn't mean if you have virtual office space where you collect your mail. That's not where you're doing your work. You're doing your work at home, then you can still qualify for the home office deduction. And it has to be a portion of your home that you use for business. You can't claim the entire square footage of the home. Okay, so it has to be a designated part of the home, usually a study, or I mean, it could be a living room, but what they don't want to see is year after year, each time that you file, that that room is changing. That also happens, right? They may go from the living room to the bedroom to the study to outdoors, so that consistency, because you have to report, the specs of the home office where you're working, and because it's going to generate a percentage of what would be allocated to the expenses that you can deduct, right? So you want to keep it consistent. Okay, now if you move to a different address, well, that's different. We're talking about the same address and you're moving around to different rooms or combining rooms. So I've kind of heard all a combination of these things. So you just want to keep the consistency of where your home office is so you can be eligible for these deductions. So some of the documentation you'll need for the home office, the measurement of the home or office space, home office space, total area of the home. And it could be something that you're renting as well if you don't own the home. And where you can get this is from a survey or a flow plan from where you're residing at, proof of payment of rent, utilities, repairs, insurance, and other expenses claimed as part of the home office deduction. You want documents that show that the home office is used regularly and exclusively for business purpose. The examiner may even, if they're doing it virtually, they may even ask you to show the home office. So don't be surprised if that happens, because I've heard of that, doing these virtual examinations. They want to see if it's set up for you to do your work. Does it look like this is where work is being conducted? Is there a desk in there? Is there a computer in there, a printer, a phone, whatever, a typical home office, just like in this picture I have here, you would expect to see. They're looking to see if, this is a valid deduction that you have on your return. So let's talk about the importance of good record keeping. I talked about earlier about having, if you spend more money than the average in your industry, that in and of itself is fine if you have the documents to support it, right? That's the ultimate defense, because it's okay that happens. It may not prevent you from being audited, but it can stop you from getting a higher tax bill, right? So it can also help you monitor. You want to monitor the financial progress of your business. Good record keeping can just really help you in so many ways. It helps you identify sources of income and it helps you keep track of deductible expenses, right? One thing that the IRS is not going to do is help you find more expenses. So you definitely want to keep track of everything that you're spending so that you can maximize your deductions within the law, right? So good record keeping and bookkeeping is very important for that. And then it makes the tax preparation easier on you and your tax professional. And then also the auditor as well, because they're going to judge you on, I shouldn't say judge, but they're going to assess how high risk you are based on the condition of your books. They just will. I did it as well, even with the larger businesses. If you're doing your books, that'll probably get you a little closer to the higher risk. If you hire someone to do the books that's, reputable, then you'll be kind of brought back down. So, they have to assess based on how you set up, how you are running your business, how high risk you are in terms of your tax return being accurate, right? So if you have stuff all over the place, can't find things, can't answer any questions about your business or anything that's on the return, then they're assessing this during the audit, right? You're going to get asked questions that the examiner already knows the answer to. They want to know if you know the answer. And then you're going to get asked questions that they may not know, and they're wanting to know how knowledgeable you are about your own business, finances and stuff like that. Okay. So supporting documentation saves you, additional taxes, interest charges, penalties. If the IRS ever questions your return, they have 3 years to do it. So you definitely want to keep track of things. They're rarely ever going to audit anything in real time. It's always going to be a year that's already closed out and passed, probably 2 years ago, you know. So it's easy to forget. And then it'll allow you to comply with multi-state taxes such as sales taxes and payroll taxes, that you have to file every quarter. So it just helps in so many ways. Okay, so the number one reason for small business audits, this is not the same for large business, but for small businesses, lack of substantiation is the number one reason for additional tax assessments. And it could be that it was a valid expense. You spent it, but having a bank statement is not enough substantiation. It's just not. They want to see the underlying documentation, the invoice. If you don't have it in the mind of the examiner, it just didn't happen. Okay? So the types of records that you'll have to keep track of: invoices, receipts, canceled checks if you use checks, a general ledger, trial balance, financial statements. If you use accounting software, that'll all be part of the reports that are in that software. Bank and credit card statements, even if the account is closed. So if you've closed a credit card statement, make sure you have every statement every month through the termination date. Okay. And the same for the bank statements as well. Contracts, agreements, legal documents, employment tax records, you have to keep for 4 years instead of 3. Proof of purchases, bills, logs, diaries, expense reports, real estate closing documents, any and everything related to your business activity. They can request and do requests, and usually it's all of it. Now, for large businesses, because the data is so voluminous, many times the examiner will take a sample. Small businesses not that lucky. They want to see everything. So how long do you have to keep the records? At least 3 years. Because IRS audits can include file returns within 3 years. Now, if a substantial error is discovered, additional years can be added, usually not more than 6. The statute of limitations are 3 years from the receipt of the file return. And like I mentioned before, it's up to you to decide if the examiner asks you to waive that limitation. And I don't know how often this happens with small businesses, because usually the turnaround time for completion of audits is not as long for large businesses. When I was doing audits, I don't think I've ever had anyone deny me a statute extension, because they understood that if they wanted to file an appeal, that it gives them additional time to file an appeal on any assessments. Okay. And if you've never filed, there is no statute of limitations. The IRS can just audit you into oblivion. There is no statute of limitations on how far they can go back. Okay, so you want to make sure you're filing those returns. And for large deductions, keep original receipts. I would never send anything original to the IRS at all. It would all be copies. And then I would copy what I'm sending them in case it gets lost in the mail, or they never got it through secured email, whatever the case may be. So it'll save you time on having to reproduce what was sent to them. Okay. So now let's talk about the IRS tax audit itself. The IRS will never, ever initiate an audit via phone. It just won't happen, ever. You'll be notified via mail, most times certified mail. I know when I was doing audits, I always sent certified mail with return receipt, so I'll know that, you received it. And then the IRS provide all contact information with instructions in the letter that you will receive. Now, some of these scammers are getting really, I don't know how they're doing it, but they're able to get like the IRS logos and have some pretty authentic looking letters that they're sending out to people. And so I would call and get somebody live on the phone before I start sending any information um, to the person that's addressed in the letter, just to verify. Okay, so you have the badge number, the location, their phone number, how they can be contacted. Okay. And the letter will usually request additional information about certain items shown on a tax return, such as income, expenses, and itemized deductions. So, and that in and of itself doesn't mean that the audit is going to be expanded. What you send them initially may satisfy them, and they may close out the case and move on to someone else that is more worthy of an audit. Okay. So keep that in mind. It could be that from what they're seeing, they need additional information, right? And then also you have the option to hire representation for the tax audit. If it seems like it's going to be something more extensive, take up way more of your time than what you have, you definitely want to consider hiring representation. So, what if you are selected for an audit? You want to respond to the written notice within a stated period of time. Trust me, you don't want to ignore the written notice because they're just going to escalate it up to the next process, right? Um, that means calling them, writing them. You want to do it before that deadline. And I would even call because, the mail is so backlogged and a lot of the examiners are, working remotely. They may only be going in the office to pick up the mail once a week, if at all, So definitely if you have a phone number, call and let them know that you did receive it. You do plan to respond so that they know that it's being addressed because you don't want them to escalate it up to the next step in the process. Okay. And then again, like I mentioned, you have the option to hire a CPA, EA, or a tax attorney. These are the only groups of people that have unlimited representation rights before the IRS. Okay. And then relax and breathe because I know sometimes, when people get something in the mail from the IRS, especially if they wasn't expecting it, it can cause a lot of anxiety. But again, something, it could be something as simple as just providing additional information that maybe they need in order to determine, whether or not they need to move forward or not. Okay. So it could be something very simple. And like I mentioned before, you want to check the credentials of the professionals that you're hiring and make sure that they're not on any disciplinary lists with the IRS. The IRS does put out, I think it's monthly, a list of people who cannot stand before them. That means they've done something to violate the rules of ethics or something to that effect. So for here in Texas, for attorneys, you can go to the texasbar.com to check to see if the tax attorney that you're working with is in good standing. And the same for CPAs, the Texas Board of Public Accountants. You can go there and check any CPA to make sure that they're also in good standing and have a license to practice in your state. All right, so let's talk about some best practices for tax preparation and audits. As I mentioned before, if you just keep in mind that your expenses should be ordinary and necessary for your business, right? So if you're talking to a fellow business owner that's in a totally different industry, what they may be able to deduct may not apply to you, right? So, the tax laws for different industries, it all goes on what is required for your business, your industry. So it's not kind of like a sweeping free fall for everybody, right? The deduction should be directly related to your business, and you want to keep good, organized records to support the tax return. That's your ultimate defense. And you don't want to commingle personal and business transactions. That's another way that you could trigger an audit if you have both personal and business transactions in a category that could be showing you having a higher than normal, expense area. And that's one way that that usually happens when you're adding both personal and business transactions together. So you want to keep those separate and only track those expenses that relate to the business. Okay. You want to store records in a safe, fireproof, water resistant location. Like I mentioned, the audits are going to be from previous years. So you want to make sure that you have the records available. And even if it's on your computer, you want to make sure that you're backing up that computer. I've had this happen to a client. They had a computer hard drive crash right in the middle of an audit. Disastrous. They had to kind of go different places to kind of come up with the records and go back and ask vendors and go back to the bank and get bank statements because they didn't have a backup on their computer. They didn't save anything to the cloud. And so you don't want that to happen to you. So whether you're, storing records physically, you want to secure those, or if you have things on your computers, they're not making these computers to last as long. Things happen to them all the time. I say do a weekly backup, you know, to make sure that you're saving all of your records. Okay. And as I mentioned before, send only copies of documents to the IRS. Copies are good. They don't need originals of anything. Okay. And have an experienced, reputable tax professional prepare your taxes. You want that person to be around when you get that letter of audit, right? So if you haven't kept in touch, or if it's somebody that's out of business already, or they just show up during tax season and then they disappear, you want someone to kind of help support you during that time, right? Because if they did the tax return and you don't have the tax work papers, then it's going to be hard for you to explain some of the things, some of the numbers that are on there, right? And so you want to consider, hiring someone. It can help alleviate some of the stress and anxiety. I can tell you, when an IRS agent is dealing with a CPA, EA attorney, it's like peer to peer, right? It's different, right? Um, so keep that in mind. Keep that in mind. And don't be afraid to disagree with a tax assessment or go to appeals. I want to see more small business owners contest, you know, because the large business owners, they do it even when they know they're wrong, right? Because they know that it's a 50-50 chance it'll go in their way. And so a lot of times I find that small business owners, they don't exercise that right enough, and they just kind of, accept it, right? So let's go over your Bill of Rights that every taxpayer have. It's not a set of rights for small business owners, for individuals and large business owners. This is for all taxpayers. So this applies to everyone. You have a right to be informed. They should be telling you what's being audited. They may not know why. They may not know why you were selected, but you have a right to know what's being audited, how long it's going to take, these type of things. You have a right to quality service, right? You should be getting return phone calls. You should be informed of different things that's happening. Just make sure that you're being treated fairly, okay? You have a right to not pay more than the correct amount of tax. If you have a feeling that, that they're just guessing or assuming, or they're not considering the information that you are providing, there's some remedies in place that you can pursue. And we'll talk about that in the next couple of slides. You have a right to challenge the IRS position and be heard. Like I mentioned before, there's not enough small business owners and individuals that are doing that. You have a right to appeal an IRS decision in an independent form. Okay. You have a right to finality. You know, um, I don't know how often this happens in small businesses, but usually, we have these large global organizations. Sometimes the audits just go on and on and on for years and years and years. But every taxpayer has a right to finality. Okay. You have a right to privacy, confidentiality. You have a right to retain representation at any given point. Even if the audit is already started, you have a right to hire or retain representation, and you have a right to a fair and just tax um, system. Okay. So let's talk about the Taxpayer Advocacy Advocate Service. It's an independent organization within the IRS, and their job is to ensure that every taxpayer is treated fairly and that you know and understand those rights that I just went over. They help individuals, businesses, exempt organizations with IRS disputes and issues. So let's just say, for instance, and they're in every state, even DC and Puerto Rico. If you are, let's just say you decide you don't want to hire representation and you're dealing with an IRS agent, um, there's a dispute, they want to assess additional tax, and for whatever reason, they're not considering additional information or they're not considering your position. You've tried talking to them, they don't want to hear it, they're not returning your phone calls. Well, this is where task group comes in and advocates on your behalf. They have cease and desist powers, where they can stop everything that the IRS is doing, come in and intervene. And it's not just during the audits, they can also come in when there are collection activities on your account. They can assist you with that. Um, so a lot of people that I've talked to didn't even know that this organization within the IRS existed. Okay, many don't. And if there's also a low income division of tasks as well. If you qualify, if you're below the poverty level, then they will provide an attorney and a CPA for you, um, to help you with disputes with the IRS. Okay. So the advocates work with the IRS to get your problems resolved. It's a free service to you. It's free. So these are the four categories that TAS can help you with. Economic burden. These are cases, where there's financial difficulty involved, in the IRS action or inaction can cause financial consequences to you and have a long-term adverse impact, right? So they can definitely get involved in an economic burden type situation. Systematic burden. What does that mean? Where the IRS's processes or their systems failed to operate as intended, right? So if it's systematic, that means it's not just happening to you, it's probably happened to a bunch of other people too. So TAS is going to come in and get involved and see how they can remedy that situation. And then they also get involved with best interests of the taxpayer, right? So in these cases, they want to ensure that you're being treated along with others fair and equitably. Okay. Now it could be that it's just one rogue IRS agents that has happened. And if the manager of that agent is not addressing the situation, then definitely make sure you get TAS involved, right? And then also if it's a matter of public policy, you know, if they determine that it's a set of circumstances that needs to be addressed by Congress, that's what the National Taxpayer Advocate is there for. She has a direct line, he or she, to Congress to address issues within the IRS that can impact people. And in Texas, there are 4 offices: Houston, Dallas, Austin, El Paso. I've got the local Dallas address here. And if you're outside the state of Texas, you can go on their website, taxpayeradvocate.irs.gov/get-help, and find a local TAS office in your jurisdiction. Okay. So in closing, I want to stress, keep good organized records. Keep up with your bookkeeping and financial reporting. That's what they're going to look to during an audit. That's what you're going to look to when you get a correspondence audit in order to provide additional information that's being requested, right? So it's very important that you keep up with these records. It's going to be from previous years. Rarely ever are they auditing things in real time. I mean, in the current tax year. If you can't prove it, then it didn't happen in the eyes of the examiner, unfortunately, unless you get someone that's reasonable that can give you additional time to provide substantiation. Okay. You want to know and exercise your taxpayer rights. You should be given a copy of the Bill of Rights before the examination even starts. Okay. And then you want to invest as your business grows, you want to invest in a team of accounting, tax, and legal professionals so you can take advantage of, laws and regulations that can minimize your taxes, right? Because, they're not going to really tell you how to do that. They're going to leave it up to you to either find out that information or hire a professional to, help you legally minimize your taxes, right? And just remember that the tax code is favorable to business owners, right? As long as all of the expenses and the credits and all the things that you take on your tax return, if it's business related, you're entitled to it. A W-2 employee, it seems like every year they're eroding things that an individual working, a 9 to 5 can deduct on their tax return. But I haven't seen that on the business side. So take advantage of the tax code and just know that if you can substantiate what you're doing, then you'll be fine. And then you want to avoid the common pitfalls. Sometimes some things are unavoidable. Like I mentioned with the example, if it just comes up that you're buying more things than someone else in your industry, as long as you can substantiate that, that's fine. It may not be enough to prevent you from being audited, but you don't want the audit to turn out unfavorably for you, right? And that is it. I want to thank everybody for attending and your attention. And now we are ready for some Q&A.
That is some valuable information you have shared. I've been making a bunch of notes here. I also had kind of a PTSD moment where I remembered a time that I was audited many, many years ago, and it was because of my tax preparer.
Mm.
Most of his clients were being audited.
Oh, wow.
Yeah, and funny, he ended up in jail, but that's another story
Oh,
entirely.
gosh.
Um, yeah. What are some of the examples of issues that a tax preparer can contest?
Well, on behalf of the taxpayer, it could be anything that you disagree with the IRS with. If you have a different position, case law that you can provide as a counter argument,
Mm-hmm.
if it's something where you don't have the documentation and then you later find the documentation to substantiate, I'd say anything that you have a counter argument with and can support it. So there's nothing really off the table. Now, even with penalties, like if you agree to the assessment and now we're on to the penalty phase, you can try to get those penalties waived. You can make an argument if it was like a, unintentional, it's something that you can argue with the IRS agent, he wasn't intending to defraud the government, things like that. And the only thing that you really can't do anything about is the interest, right? Because that's going to continue to accrue until the entire tax assessment that you agreed upon is paid. But everything else is up for negotiation and for counter argument.
Okay, that's interesting to know. If anyone has any questions or comments, please feel free to put them in the chat or unmute yourself and ask Angela directly. Not a problem.
Hi, Angela. This is Roger. How you doing?
Hi, how are you?
I'm good. I'm good. Thank you. That was another great session on that. I feel like I almost went through an audit just now listening to everything. But just great information. With regarding everything that's gone on with COVID and the IRS under such constraints as far as time wise and people, right? They just don't have enough people. Where do you see audits kind of going in the next, year or two, only just from that standpoint?
Well, what I see, th- one thing, what's happening right now is they can't keep up. It's so much work. Um, the people that remain, they can only do so much, right? So there's way more work than they do have people in place. So what I see happening is either they're going to be more targeted in where they um, do their compliance activities. Like I mentioned, that high income net worth project that I was on. And right before I left, they had started a new group with partnerships because that had been a decade long overlooked under audited taxing entity. So what I see happening is they're going to be more targeted in the areas where they're seeing either a lack of coverage historically, and they're going to divert some resources there, or they're going to just be more targeted in the people where there's the highest risk. I see them coming up with more compliance software programming where they don't really need resources to do field audits, but that they can have a computer software to just kind of go in and just kind of check to see if things match up with other sources of information, from third parties that they're receiving. And even with foreign banks, foreign banks also cooperate with the IRS. Back in 2012, I was on a project where criminal investigations had turnover, and I had Texas, New York, and New Jersey. It was like a what they call this program where they will waive criminal prosecution if you just turn over the records. It's like some kind of voluntary compliance program, right? And so these are offshore banks that were cooperating with the IRS. They still got the civil penalty and everything, but they didn't have to go through like a criminal investigation process for failing to report, you know, bank accounts and foreign, income in foreign banks, even though they were US residents. So I see them really relying on just other means to do some of this compliance activity that may not include the kind of manpower that they would need for field audits.
Got it. What do you on the project you were working on, or what would you consider the threshold of like high income, high net worth?
Well, the threshold was if it was 10 million in assets and above, then and it could be a combination or any individual of the businesses, because most times a person had multiple businesses, S corps, partnerships, and then of course their individual return. And so it could have been one of those businesses or all of those businesses. If it met that 10 million in assets and above, then they were considered a high net worth
Got it.
individual.
Got it. Is we've had a lot of PPP and we've had a lot of idle stuff kind of go on. We've had some, county grants and some different funds kind of going in and out of people's businesses. Um, any insight you can give us, on that kind of stuff?
That is actually under the Office of Inspector General's jurisdiction with the SBA. So that wouldn't really fall under the IRS, unless they had like a special task force or something, which I don't see that happening because they're already struggling with their own workload. But the Small Business Administration is under OIG, Office of Inspector General, and they have a set of auditors that, what I understand, they're beefing up right now. They're hiring people right now to come on board to examine these COVID-19 relief programs. So yeah, so that falls outside of the IRS's current
Okay.
jurisdiction.
For some reason, I thought there was a form that you had to fill out if you received like the PPP funds because it was coming into the general account as income, but you didn't need to report it or something like that. But
Right. So there's a rule in place that the if you had a forgivable PPP, that it does not need to be included in income, right? So you have to clearly identify what that is, and hopefully you don't make a mistake and report it, as income. Now you can always go back and amend if that does happen. You can go back and amend your tax return, but yeah, because normally under normal circumstances, canceled debt of any kind is reportable as income under the IRS. But so they had to, include in the laws that it would not be included um, due to COVID, this COVID-19.
yeah. Well, thank you for answering that. I appreciate that.
Angela, this was super informative and really easy to understand, so thanks for that. I have a question about a brand new business. Obviously, good bookkeeping practices are a good idea, but is there anything that people kind of trip up as they're setting up their business that you have some shortcuts or tips on?
What I find in the beginning, let's say for instance, you have not gotten your documents together, and so you may not have a business bank account. What I would suggest is have a separate account. It doesn't have to necessarily be a business account, but as long as it's separate from your personal household transactions and expenses, it'll be easier for you to track what you're spending on the business, what money is coming in, and until such time you can get an official, because the bank will need, documents from either the local county clerk or the Secretary of State before you can open up a business bank account. And so what I'd say is just do a separate account. It doesn't have to be a formal bank account, because it'll be easier for you to kind of keep up with all of your business activity when it comes time to do your taxes.
Okay, great, thanks.
Mm-hmm. You're welcome.
That was a great question. Thank you for that. Thank you. Um, okay, one last question that I had. You talked about the statute of limitations on the records and everything,
Mm-hmm.
but that they can request that you waive that statute or
Yes, if they
waive
need
those
additional,
limitations?
yeah, if they need additional time to finish the audit and is getting close to that tax period that they're auditing expiring, they can request. They probably will request before the audit really gets underway, and you're not required to extend it, you know. Um, but just know that's additional time for both you and the examiner, right?
Okay.
'Cause if you need additional time to come up with documents, or if you want to move forward with resolution activities, like maybe going to appeals or mediation, that also gives you enough time to do that as well. So
Okay, gotcha. So it's more of a time thing rather than, ooh, let me dig further.
yeah, because typically, what the managers are having people do now that I've seen change from when I first started, is they're having them to limit the issues, right?
Mm,
When I first started back in 2010, we could have up to 5 issues, and some people would just keep digging and digging until they find something. But with the shrinking labor force and the amount of work, the manager's like, we listen, if there's nothing there, just move on to the next person. It's too much work for you to get fixated on one business or one individual taxpayer when we have all these audits that we need to do. So they have really started to limit how much the examiners can even look at. So they'll limit it to just 2 or 3 items, and you have to justify to the manager why you need to look at more.
mhm.
So yeah, and I think it's
Gotcha.
all as a result of just a shrinking um, labor force there.
Gotcha, gotcha. How long has TAS been in place?
Oh gosh. I want to say, I don't know when they got started. I must admit, I did detail in that group. While I was there, I didn't even know it existed, right? Because most of the large businesses, they get the EAs, they get the tax attorneys, they throw the whole book at the IRS because they have the resources to do it, right? But I did a detail there in the low income tax group. And so I wasn't even aware that these resources were there. They don't really advertise it, but it's there, and I try to tell as many people as I can who have disputes and maybe are not in a position to hire a tax professional that they don't have to just suffer, if they feel like they're being wronged in any kind of way, or if they agree to an initial payment plan and their circumstances change or they lost their job and so now they have to renegotiate. And if the IRS representative is unwilling to listen to your concerns, then that is where you have to get TAS involved to kind of help you advocate so that they can listen and then come up with a payment plan that you can live with given your current circumstances. And I just find that people just aren't aware that that organization exists, and it does, and they're very serious about advocating on taxpayers' behalf.
That is, that in itself is some great information. I'm sure not very many people knew that that
Mhm.
existed. Uh, that it kind of makes you feel better, or makes me feel better. The IRS, they really are looking out for the taxpayer in some areas too. So,
Mhm.
uh, any last words before we move on?
No, I had a great time sharing this information, and just know that that group is there. Reach out if you need assistance or have questions, and just keep doing your business and keeping track of everything, and just don't worry if you get that letter. Just it'll be fine.
Like you said, just breathe, take a
Just
breath.
relax and breathe. That's right. And this is where you can stay connected with me. Follow me on social media. I've really enjoyed this time with you guys.
Thank you. And with the SBDC, really do appreciate the time that you've spent and all of the knowledge that you've shared with us and our clients.
Thank you.
Um, and now I would love to share some information with you all. You will be getting a survey. And if you would please take just a moment to complete that survey, let us know how we're doing. Let us know what other topics you would be interested in learning. And we would love to hear how we can improve our program. On the slide that we're showing now, some of our upcoming webinars. Like I mentioned earlier, SBDC is grant funded, and because of that, we can bring you all sorts of resources like these webinars at no cost. And tomorrow we have part 3 of how to write a top-notch website and copy with Ashley Cook. This has been a great series as well. And then finally, we get some information on business plans, and looking forward to Rebecca bringing that business plan basics to us. We've had a great amount of information shared, a lot of response on our QuickBooks and series. We've got Stacy Kildall and Bryce Forney coming back for this week, Accounting Life Cycles. Next week, QuickBooks SOS. I've been there. This will be some good stuff. And then Rebecca back with some more financial bookkeeping for funding needs. And our HR series is coming to an end with CJ Pettit and Hiring Smart. This has been a great series as well. Thank you all for joining us. I just want to remind you that you can access our website at sbdc.nctc.edu. If you want to register for our webinars, you can do so at the site, or you can use the QR code in the upper right-hand corner of the slide on screen now, and that'll take you right to our Eventbrite page. We are funded, grant funded, and just want to thank some of those that are actually fund us so that we can be here to help all of the business owners, the Small Business Administration, the state of Texas, North Texas SBDC Regional Office, and North Central Texas College, our host institution. I want to thank you all for joining us today. Come back tomorrow, hear more about your websites, and keep up with us. And we look forward to seeing you all on our future webinars. Thanks so much. Have a great day. This will end the webinar.